The thing about the S&P 500 is not that it's a bad investment. It's that it's the right investment used at the wrong time, and for most Americans over 50, the window to use it the way it was designed to be used has already closed. The math changes completely the moment you stop putting money in and start taking money out. And that shift is more destructive than almost any market crash you've ever heard of. Americans in their 50s right now have a median retirement savings balance of $460,000. Americans in 2026 believe they need $1.46 million to retire comfortably. That's a gap of roughly $1 million. And the default response, keep everything in the S&P 500 and let it grow, is not a plan. It's a prayer dressed up in historical charts. I'm going to tell you exactly why and exactly what the architecture actually looks like when you build for the road you're actually on rather than the road you were on 10 years ago. Here is what this video is going to do. I'm going to explain why buying the S&P 500 after 50 is the wrong move, not because the index is bad, but because you're asking the wrong tool to do the wrong job at the worst possible time in your financial life. Every advantage the S&P 500 offered during your accumulation years reverses when you flip into withdrawal mode. By the end of this video, you'll understand the exact mechanism, the real numbers, the psychological trap that keeps people stuck in the wrong portfolio design, and the 3 structural decisions that actually determine whether you run out of money in your 70s. Let me give you the central frame. Think of the S&P 500 like a Ferrari, not a bad car. One of the greatest machines ever built. On a dry, open highway, it is perfect. It rewards aggression, the long, straight road of your 20s, 30s, and even 40s. That's Ferrari country. You hold the throttle down, you absorb the occasional rough patch, and the machine rewards you. But now you're 50-something, and the road ahead has a hairpin turn in wet weather. A sharp, technical corner requiring precision and deceleration, not raw speed. You don't take a Ferrari through a hairpin turn at full throttle. Doesn't matter how beautifully it performed on the straight. At full speed through that corner, you're in the wall. Same car, same driver. Different section of road, completely different outcome. That image is going to come back every time I explain a new layer of this problem. The car hasn't changed, but you are absolutely on the wrong section of track. In a few minutes, I'm going to show you what happens to 2 identical portfolios when the only variable is the timing of their losses and how the difference compounds to $665,000 on the same starting balance. But first, I want to explain why most people never see this problem until it's too late to fix it. The reason is that during your accumulation years, volatility works in your favor. When the market drops and you're still contributing, you're buying more shares at lower prices. Dollar cost averaging is a genuine structural advantage. Volatility is your friend. The S&P 500's brutal swings are essentially a discount program for long-term investors. So you spend 20 or 30 years training your brain to ignore volatility. And that training is exactly correct for the first phase of your financial life. The problem is that the brain doesn't update its model when the phase changes. Most investors spend decades concentrating on one figure, average annual return. They believe that getting the average right will make retirement straightforward. However, for anyone withdrawing income from a portfolio, average returns are only part of the story and arguably the less crucial part. The other half is sequence. The order in which returns arrive during the early years of retirement can permanently change outcomes, even if long-term averages end up the same. This is called sequence of returns risk, and it is the most dangerous thing in retirement finance that most people have never heard of. 2 retirees both average 5% per year over 20 years, both withdraw $50,000 annually from $1 million portfolios. The only difference is when losses occur. Same average return, but a $665,000 difference in ending balance. And the bad sequence portfolio was in serious distress by year 5. $665,000 on the same average return, on the same starting balance. The only variable is the order. The issue, known as sequence of returns risk, refers to how the timing of withdrawals paired with stock market losses can affect how long your retirement savings last. Your first 5 years of retirement are the danger zone for tapping accounts during a downturn. according to Amy Arnott, a portfolio strategist with Morningstar Research Services. If your portfolio dropped at least 15% in your first year of retirement and you also withdrew 3.3% of the balance, that combination would increase your odds of depleting the portfolio within 30 years by 6 times compared with someone who has a first-year positive return. 6 times. Same portfolio, different first year. This is not a fringe risk. It is the central mechanical failure mode of every all-equity retirement portfolio. Here is what that looks like in the real world. The bursting of the tech bubble in 2000 ushered in a prolonged bear market. From March 2000 through October 2002, the S&P 500 fell more than 47% over a period of more than 2 years. A retiree who started withdrawals in March 2000 on a $1 million S&P 500 portfolio, withdrawing $50,000 a year, saw their portfolio drop to roughly $455,000 by the end of 2009. Even by the end of 2019, after a strong recovery, it remained below $400,000. This demonstrates the risk of relying solely on the S&P 500 in retirement. The same $1 million left untouched would have survived and eventually compounded. But with withdrawals, the damage is permanent. Not because the market didn't recover, it did, but because every share you sold at the bottom to fund your expenses was a share that was no longer available to participate in the recovery. Forced to sell assets when prices were low just to generate that same $50,000 income, each withdrawal carved out a much larger percentage of a shrinking portfolio, creating a devastating downward spiral that's incredibly hard to escape. That's not a market failure. That's a portfolio design failure. You don't take a Ferrari through a hairpin turn at full throttle, and before you say, well, 2000 was unusual. The 2000s, often called the lost decade, produced a CAGR of approximately negative 0.95%, the only negative decade since the 1930s. Individual decades vary enormously, from negative 0.9% in the 2000s to positive 19.4% in the 1950s. An investment of $100,000 in the S&P 500 on the eve of Y2K was worth $90,934 at the end of 2009. Things look even worse when you consider inflation. Over that 10 years, the consumer price index rose by more than 28%. So the loss in stocks and the increase in inflation caused a combined loss of purchasing power of over 37%, a lost decade indeed. It happened. It can happen again. That's not pessimism, that's pattern recognition. Now here is where the analysis gets sharper, because sequence of returns risk isn't just about market crashes. It's about a specific window of time that researchers call the retirement risk zone. 50.6% is the probability of portfolio failure for a retiree who experienced a significant market shock at the point of retirement, compared to only 33.5% for a retiree who experienced the same shock 15 years later. This is why managing the retirement risk zone, the 5 to 10 years immediately before and after you stop working, is the most critical task in building a durable financial blueprint. Same shock, same portfolio, different timing. 17 additional points of failure probability purely based on when the market decided to break. That's nearly 1 in 5 additional people who run out of money, not because they made bad decisions, but because of when the calendar landed. The hairpin turn, after 3 consecutive years of strong gains, including a 17.9% total return in 2025, the S&P 500 has encountered difficulties in early 2026. It's one of the least discussed risks in retirement planning, and with the S&P 500 experiencing 5 consecutive weeks of losses and down about 5% year to date as of late March 2026, it's especially relevant for investors who retired in the past year or two and are now taking withdrawals in a declining market. For investors who retired in 2024 or 2025 and are now drawing from their portfolios in this environment, the sequence risk dynamic is no longer hypothetical. They are experiencing it firsthand, selling assets at low prices to fund withdrawals, which permanently decreases the number of shares available to benefit from any recovery. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, the financial industry's answer to this problem has historically been something called the 100 minus your age rule. This rule of thumb suggests that you should subtract your age from 100 to determine the percentage of your portfolio that should be allocated to equities. The remainder represents the percentage you should allocate to fixed income assets like bonds. At 50, that gives you 50% stocks, 50% bonds. Clean, logical, increasingly wrong. The problem is that this rule was built for a world where retirements lasted 10 years and bonds generated meaningful income. Using your age to determine your stock bond mix is the default for retirement investing. But now that retirement can last 30 years or more, it's time to rethink the rules on asset allocation. S&P 500 total returns. With dividends reinvested from 1950 through 2025, the worst rolling 20-year period still produced a positive annualized nominal return of roughly 6% per year. That means if you have a genuinely long time horizon, cutting off equity exposure at 50 is actively leaving compounding on the table. But here is the critical distinction. There are two completely different jobs a portfolio has to do, and most people only ever build for one of them. Job one is the growth engine. This is the accumulation machine. Maximum equities, long time horizon, let the market's volatility work for you. The S&P 500 is exactly right for job one. It's the Ferrari on the highway. Job two is the distribution machine. This is the withdrawal architecture. Designed to produce income, cushion against bad sequences, protect the base of compounding during down years. The S&P 500 alone is exactly wrong for job two. After 50, you need to start building job two. Not by abandoning job one entirely, but by intentionally constructing a second portfolio with a completely different mandate. Most people have one pile of money and assume it can do both jobs simultaneously. It cannot. That's the design error. The classic advice, move to bonds as you age, is an oversimplification that can leave retirees underinvested and running short of money. Modern retirement portfolio research shows that a more nuanced approach, including a temporary bond tent at retirement and a rising equity glide path through retirement, can significantly improve outcomes. A bond tent starts with a temporarily higher bond allocation at retirement and then increases equity exposure in later retirement years. The intuition is that the first 5 to 10 years of retirement are the most dangerous for sequence risk. Once you survive that window with your portfolio intact, growing your equity share helps ensure you don't run out of money at 85 or 90. That last part surprises almost everyone. The research says that in your late retirement, you should probably have more stocks than traditional wisdom suggests, not fewer. Because longevity risk, outliving your money, is a bigger threat at age 85 than sequence risk is. The S&P 500 is excellent for fighting longevity risk, but it needs to be properly sequenced. You can't just pour it into one pile and hope the timing cooperates. Knowing these numbers and actually building a system around them are two very different things. I spent a long time sitting with accurate information and an inadequate plan because data without architecture is expensive confusion. That's why I built the Exit Code. It's a digital book built on 50 years of actual retirement data, not opinion, not market forecasting, not motivational content. It's a mathematical framework that turns "I hope this is enough" into a specific date and a specific number. Inside, there's a full breakdown of what I call the 4% trap. Why the standard withdrawal rule was engineered for 30-year retirements, and how it breaks under modern longevity assumptions alongside a dynamic withdrawal method that adjusts to market conditions rather than mechanically draining your portfolio in a down year. Morningstar tested multiple dynamic withdrawal methods against its conservative base case of fixed inflation-adjusted spending each year. Every single flexible strategy the researchers examined supported a higher starting safe withdrawal rate than the fixed approach. That chapter alone changes the math for most people who read it. There's also a chapter on the 58% rule, because more than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances. Your strategy needs to survive not just your planned exit date, but the forced one that statistically lands 3 to 5 years earlier. If your plan only works under ideal conditions, it isn't a plan. It's a wish with a spreadsheet attached. And there's a full analysis of the invisible bill, the insurance gap that appears when you exit before Medicare at 65. The enhanced premium tax credits that had lowered ACA premiums since 2021 expired at the end of 2025 and were not renewed for 2026. For early retirees, this means anyone earning above roughly $62,600 as a single person pays full price for marketplace coverage, which can exceed $1,500 a month at age 62 in some rating areas. That number needs to be in your model before you make any retirement income decision. You can get the exit code through the link in the description. It costs less than one dinner out, and it won't send you a monthly invoice for 1% of your assets to explain half of what's in it. Now back to why the math gets worse the longer you ignore the healthcare piece. Here's a dimension of retirement risk that people consistently mismodel because it's invisible while you're still working. You have employer-sponsored health insurance. Your employer pays most of it. Healthcare feels like a rounding error in your budget. Then you retire, and the bill appears. Healthcare is one of the largest expenses Americans face in retirement, but it's also one of the hardest to estimate. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. A 2026 report by EBRI found that some couples may need up to $469,000 in savings to cover their healthcare expenses in retirement. To have a 90% chance of meeting their healthcare spending needs in retirement, a man will need to have saved $212,000 and a woman will need to have saved $252,000. Couples enrolled in a Medigap plan with average premiums will need to have saved $267,000 for a 50% chance and $405,000 for a 90% chance. Those figures are not part of your 401k. They're a parallel obligation sitting quietly next to your portfolio, growing on its own schedule. The standard Medicare Part B premium rose 9.7% in 2026, from $185 per month in 2025 to $202.90. This is the third straight year that Part B increases have outpaced Social Security's cost of living adjustment. The 2026 Social Security COLA added roughly $50 per month to the average retiree's check. Medicare Part B immediately claimed 18 of that through the premium increase. You got $32 net. Healthcare inflation doesn't negotiate. But here's the genuinely expensive problem. That's for people who already have Medicare. Medicare starts at 65. According to the 2025 EBRI Retirement Confidence Survey, the median expected retirement age among workers is 65. The median actual retirement age among retirees is 62. That 3-year gap has persisted for decades across multiple surveys. If you actually retire at 62, which is the statistical median, you face 3 years of private health insurance. Estimated average monthly benchmark premiums escalate to $1,072 at age 62, $1,101.80 by age 63, and top out at $1,120 for those ages 64 to 65. A couple in the early 60s faces a combined full-price silver benchmark premium of around $2,849 per month before tax credits. That's about $34,188 per year before deductibles, co-pays, co-insurance, and prescriptions. Now, do that math on your withdrawal model. If you plan a 4% withdrawal on $500,000, $20,000 annually, your healthcare costs before Medicare already eat that and put you negative $12,000 before rent, before food, before a single activity. The 4% rule was not designed for a $34,000 invisible bill in the pre-Medicare years. It assumed Medicare was already running. According to HealthView Services, an average healthy 65-year-old couple's annual healthcare costs are projected to rise from $17,003 in their first year of retirement to $55,513 by age 85. That growth trajectory means a healthcare budget that feels manageable at 65 has more than tripled in real terms 20 years later. This is compounding against you on a completely separate track from your investment portfolio. And the S&P 500's 10% historical average has to fight through all of it simultaneously. Let me introduce someone here. We'll call him Dave from Ohio. Dave is 52. He's got $480,000 in his 401k 100% S&P 500. He plans to retire at 65. He tells himself, 13 more years. The S&P averages 10% historically. I'll compound my way to 2 million and I'm done. Dave is not thinking about the retirement risk zone. Dave is not thinking about the healthcare gap. Dave's plan works perfectly if the market cooperates, if he stays employed until 65, and if his health gives him the option. We will come back to Dave, and the ending is different from what he expects. Here is the hard reversal at the core of this whole conversation. You think the problem is not having enough money in stocks. The actual problem is having your entire investment architecture designed around a single tool that provides no income, no downside cushion, and maximum volatility during the exact window where volatility causes the most permanent damage. This isn't a story about the S&P 500 being bad. It's a story about using a growth engine as your sole distribution vehicle. Those are different machines. Building both is the actual task. Stay with me, because this next part changes the calculation for most people watching. There's a plan that almost everyone with a savings gap builds in their 50s. It goes, I'm behind, so I'll work until 67, maximize contributions in the final 15 years, let the market do the heavy lifting, and retire with enough to make everything work. Clean logic. One significant problem with it. More than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances. The median age, they call it quits, is 62, 3 years shy of the traditional retirement age of 65. That 3-year gap has persisted for decades. It is not a recent phenomenon. It is the baseline. Your plan to work until 67 is a plan that statistically fails more often than it succeeds. The Employee Benefit Research Institute and Greenwald Research found that 46% of Americans who retired last year left the workforce earlier than they originally planned. The forces behind those early exits should concern anyone who assumes they will get to choose when their career ends. Unplanned health conditions and corporate restructuring were the two largest forces pushing workers out of their careers ahead of schedule, according to the 2026 EBRI survey. Circumstances entirely outside the individual worker's control were responsible for 76% of all unplanned early retirements. 76%. You're not the driver. You're a passenger who thinks they're driving. Think about what this does to the standard, I'll just keep contributing and stay in the S&P 500 strategy. That strategy requires continued contributions. Contributions require continued employment. Employment is something that 76% of early retirees discovered was not actually under their control. So the strategy, maximum contributions, long runway, let the compounding work, has a structural dependency that the math never accounts for, because the math assumes you control the timeline. A separate EBRI study of 3,600 retirees aged 62 to 75 found that 58% had retired earlier than planned. In that study, 38% cited health problems or disabilities as the primary driver, while 23% pointed to employment disruptions. These findings matter because many workers rely on the assumption that they can simply work a few extra years to make up for insufficient savings. That assumption is a plan with a false dependency. Now come back to Dave from Ohio. Dave is 52. His strategy requires 13 more years of employment. Statistically, Dave is more likely to stop working at 62 than 65. 3 fewer years of contributions, 3 additional years of distributions. And if Dave hits a bad sequence in his first few years of forced retirement with his $480,000 entirely in the S&P 500, no cash buffer, no bond cushion, the sequence problem and the healthcare gap activate simultaneously. They don't add, they multiply. That's how people who did everything right still run out of money at 72. By the way, the comedic version of this, is that Dave's financial advisor, upon hearing all of this, will say, "Stay the course," said with great conviction, said while collecting 1% of Dave's assets annually. Financial advisors often note that while retiring into a strong market can put the wind at your back, the opposite can diminish your portfolio over time. That's true and vague enough to cover any outcome. The math on stay the course, on $200,000 over 30 years at 7% average returns, a 1% annual advisory fee costs you approximately $373,000 in foregone compounding. $373,000 for advice that aged as well as most hot takes. I respect the business model. I just want you to understand what you're buying. And for Dave specifically, Dave is actually doing fine right now. He sends me comments telling me these videos are too negative. Dave, the Ferrari is wonderful. I love the Ferrari. I drive it too. I'm asking what your plan is for the wet hairpin turn that appears in roughly 12 years, because I've looked at the map and it is definitely on the route. Let me now make this concrete with specific numbers. You are 53, you have $500,000 in a 401k 100% S&P 500. You plan to retire at 65. Your target retirement spending is $60,000 per year. Scenario A, you execute the plan perfectly. Market cooperates. You contribute the full $23,500 annually, plus $8,000 in catch-up contributions as currently allowed for people aged 50 to 59. That's $31,500 per year for 12 years. At a 10% historical average, your portfolio at 65 is approximately $2.1 million. You withdraw $60,000 annually, which is a 2.8% withdrawal rate. You have meaningful room to absorb a sequence problem. The S&P 500 did its job. Ferrari, dry, highway. This works. Scenario B, you're forced out at 61, 4 years early. You miss 4 years of contributions, roughly $126,000 in contributions, plus their compound growth. Your portfolio at 61, before any market volatility, is roughly $1,100,000. Then the market drops 25% in your first year of forced retirement. Not unusual. The S&P 500 fell 25.4% from January to October 2022. Your balance drops to $825,000. You need $60,000 a year plus. Now, private health insurance at about $12,000 annually for 3 years before Medicare. That's $72,000 in year one from a portfolio that just contracted. Your effective withdrawal rate in year one is 8.7% on a volatile, pure equity portfolio. The massive range of actual maximum sustainable withdrawal rates over different 30-year historical periods is 4% to 10%, demonstrating that the safe withdrawal rate is entirely dependent on the market sequence you happen to retire into. You are at the upper edge of that range in your first year, with no buffer. That's not a plan that survives long. The difference between scenario A and scenario B is not your savings discipline. Both scenarios save diligently. The difference is a forced exit date and zero structural resilience in the portfolio for that event. The S&P 500 cannot solve that problem by itself. It is a magnificent growth engine with no braking system. Here's what scenario B actually needs. It needs what I call the 3 structural decisions, and these are specifically calibrated to what we've talked about today, not generic advice. First, the buffer. 2 years of projected retirement expenses in this scenario, roughly $120,000 held in a money market account or short-term bonds, completely separate from the equity portfolio. This is the mechanism that breaks the sequence problem. When the market drops in year one, you draw from the buffer. You don't sell a single equity share at the bottom. You give the S&P 500 time to recover while you live off cash. This is what every piece of serious sequence risk research converges on. Keep at least 2 years of spending in stable cash at all times so you never have to sell equities in a down market. It's not sophisticated. It's engineering. It costs you some theoretical return in exchange for eliminating the most destructive risk in retirement finance. Second, the stress test. Run your retirement model at 62, not 65. If your retirement plan hinges on working until 67 or 70, stress test it. What would your finances look like if you had to stop at 62 instead? That's not a worst case scenario. It's one of the most common outcomes. If your plan survives the forced exit at 62, the planned exit at 65 looks easy. If it only works at 65, you are one layoff or one diagnosis away from a crisis. Run the number. Actually run it. With the real healthcare premium for your age and location plugged in, not estimated. Third, the dynamic withdrawal methodology. Not what percentage am I withdrawing, but what is my decision rule when markets are down 20%? The answer cannot be same withdrawal. I'll just hope it recovers. Morningstar's forward-looking lens explains why its base case safe withdrawal number has bounced between 3.3% in 2021 and 3.9% in 2025, alongside shifting market conditions. A dynamic withdrawal rule that reduces distributions in bad years by even 10 or 15% preserves the portfolio base enough to dramatically change 30-year outcomes. This is the mechanical fix that transforms a sequence risk problem from catastrophic to manageable. Go back to Dave from Ohio one final time. Dave made 3 changes, not dramatic ones. He moved 2 years of projected expenses into a money market fund, a buffer that cost him about $450 in foregone annual returns on that small slice of his portfolio. He shifted 10% of his S&P 500 holding into a total bond market fund, with a plan to gradually increase that to 30% over the next decade. And he ran his own scenario B. What happens if he stops working at 61, not 65? He discovered his plan survived barely, but it survived. That single exercise changed the decisions he makes about spending and contributions more than any market update ever had, because he's now making decisions knowing the realistic scenario, not the optimistic one. The Ferrari is still running. He just knows where the hairpin is. Lazy investing built more fortune than crypto memes. And here's the final thing I'll leave you with. The S&P 500 is not the villain of this story. It's the most powerful wealth-building tool ordinary investors have ever had access to. The villain is applying an accumulation phase tool to a distribution phase problem and calling it a retirement plan. Every hour you spend optimizing which S&P 500 fund has the lowest expense ratio, while ignoring your sequence risk architecture, your healthcare gap, and your forced exit probability, is an hour of false precision. The boring document, the one that shows what a 35% portfolio drop in year 1 does to your specific withdrawal math, that document matters more than anything. A financial media channel will tell you this. Weak. I read those documents. 10 years of building and running a business, surrounded by people who think in actual risk terms rather than average return projections, taught me that the real money in retirement planning is in the unglamorous decisions that nobody makes YouTube videos about. Until now. After 3 consecutive years of strong gains, including a 17.9% total return in 2025, the S&P 500 has encountered difficulties in early 2026. The probability of portfolio failure for a retiree who experienced a significant market shock at the point of retirement is 50.6%, compared to only 33.5% for a retiree who experienced the same shock 15 years later. Which is why managing the retirement risk zone is the most critical task in building a durable financial blueprint. More than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances. According to Fidelity Investments' 2025 estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. Those numbers don't care what your average annual return was. They only care whether you built for them.